How bonds fit into your financial plan. Let's talk about it. Bonds play a key role in an investment portfolio, but often take a back seat to the stock market. Let's talk about bonds, the role they play in an investment portfolio, and how they can improve the probability of success in your financial plan. My name is Neil Falkenberry. I'm a CFA, a Managing Director and Investment Advisor at Modern Wealth Management, and we're going to discuss bonds and their role in your financial plan. Let's begin with a primer on bonds for the benefit of those who may be more familiar with investing in equities or investing in real estate. A bond is a contract to lend money to a borrower for a fixed period of time at a set rate of interest. Normally, that interest rate is set for the life of the bond, which is why bond investing is sometimes referred to as fixed income investing. There are types of bonds that exist where that interest rate can be variable. It can float with Fed funds or LIBOR rate or even the CPI index, for example. But the predominant number of bonds issued have fixed rate interest rates. So a bondholder, you're a lender, and as such, you're entitled to receive interest over the life of the bond and receive repayment of your principal at the maturity of the bond. Bonds are often backed by specific collateral as protection in the event of the default. Sometimes that collateral is implied. If you buy a treasury bond, you are loaning money to the U.S. government, and that bond is backed by the full faith and credit of the U.S. government and its ability to tax citizens or to print currency. If you buy a municipal bond, that bond is backed by sales taxes or property taxes of a state or county or agency authority. If you buy a corporate bond, it could be backed by manufacturing facilities or specific real estate or other assets that a company may own. So that collateral protection for bonds provides a great deal of security to bondholders that is different from equity holders that have no guarantee of collateral. In addition, bonds are senior in the capital structure of a company. And by that, we mean that bondholders get paid first before any money is made available to equity shareholders. This is particularly important in the event of a default, of a bankruptcy. Bondholders have to be completely satisfied before any funds are available for distribution to equity shareholders. Bonds are typically sold in units of $1,000, referred to as par value. A bond with a 5% interest rate, referred to as its coupon, would pay $5 per year over the life of the bond, its term, with that $1,000 par value being paid back to you at the maturity date of the bond. Maturity dates typically range from 30 days to 30 years. So I mentioned that the collateral protection and seniority features of bonds make them safer than equities. However, in a world where the return of an investment is a function of its risk, the safety of bonds then comes at a cost of having lower returns than we would expect from equities. So in chart 1 here, I'm illustrating the returns of investing in stocks, 2 different types of bonds, as well as cash or CDs, and our inflation rate since 1992. The blue line is the return of common stocks, right? The king of compounding and generating wealth, right, of all asset classes. The bottom line, the 2 gray lines, the dashed line is inflation, and the solid gray line is the return from investing in 30-day treasury bills. You can also think of this as money market funds or bank CD deposits. Okay? Those deposits have really done very little in terms of creating wealth. And as a wealth management firm, we define wealth as increasing purchasing power. So money market or CD investments have simply grown in size nominally, but have not increased purchasing power and have simply kept up with inflation. Bonds fit very nicely here between equities and inflation or CD type strategies. The red line is the return of a portfolio of corporate bonds. The orange line, a portfolio of treasury bonds. We would expect a portfolio of treasury bonds to return less than that of corporate bonds because corporations can't print money or tax an entire country if necessary in order to facilitate repayment. So they have slightly higher risk and come with a higher rate of return. So the compound annual growth rates here of these asset classes, illustrated by the compounded growth of $1, is roughly 10.4% for equities, about 5.5% for corporate bonds, 4.5% for treasuries, and about 2.2% for inflation and money market or CD strategies. So that puts bonds, again, nicely in the middle between very conservative investments and equity investments. However, note the very smooth behavior of those bond returns. right? Very slow, steady growth in the orange and the red lines. Compare that to the volatility that we see in equities. A very large decline around the dot-com crash in 2000, 2001, a 50% decline in 2008, 2009. COVID now barely shows as a blip here on the chart, but 2022's decline of 23% certainly still does appear. So bonds do not offer that same level of return that equities do, but their volatility is much, much more depressed than you would see in an equity portfolio. So this has been true for the last 30 years. It's also been true for the last 100 years. In chart 2, these are the returns since 1926. These are annual returns, so they don't capture all the intra-year volatility that was reflected in the first chart, but these same relationships still hold. The purple line here is the return of small cap stocks. The blue line is large cap stocks, roughly the S&P 500. Again, corporate bonds fitting there in the middle, treasury bonds slightly below that, and then again, T-bills, money market, CDs, matching roughly the rate of inflation. So a couple of points here to take away. One is that bonds are producing wealth, right? That bonds are producing a return in and above the rate of inflation. That makes them an attractive wealth creator and worthwhile of consideration as an investment on their own merits. Secondly, their volatility is, while their returns might be half of equities, the volatility is even less than that, right? So it's a very smooth type investment experience, which makes them appropriate for a certain type of investor. Now, while bonds might be attractive as a standalone investment, it is their use in a portfolio combined with equities where bonds really illustrate what I would consider a superpower. So an asset class that produces cash flow has a lower risk return profile and is not highly correlated with equities is very valuable. And when I say not highly correlated, specifically I mean that when equities run into trouble and have significant declines, bonds have tended to do really well. Let's think about why this might be particularly important in a financial plan for a retiree, right? Or you're approaching retirement. Let's say you're in your late 40s or your early 50s and you're beginning to think about retirement and think about portfolio construction and that concept. So in retirement, an investor might need to supplement income they have from pensions or Social Security with income from a portfolio. We saw in that first chart the successive corrections or bear markets we had in equities around the dot-com crash in 2000 and the great financial crisis. That experience was a crash, a recovery, a crash, and a recovery. And it was a 14-year time period there before you set new highs in the equity market. Now, that's not a terrible problem for a young investor in their 20s or 30s, right, where there's plenty of time to save and wait for better investment equity opportunities. But if you're a retiree and you're living in your portfolio and you're spending 3 or 4 or 5% of your assets each year for 14 years, at the end of that 14-year period before equities have started to produce new highs, your portfolio is now a fraction of where you were from a starting point. So from a retirement perspective, you need some protection against the possibility of extended or multiple bear markets in equities. And this is where bonds really illustrate what I consider their superpower. So let's look at chart 3 and the last few events that have been periods of distress for equities. We have the great financial crisis here, and I'm just measuring that as calendar year 2008, not necessarily the peak of that market to the low in 2009. Stocks were down about 36.5%. Bonds were positive, 13.74% in 2008, really helping buffer that volatility in the portfolio. In the fourth quarter of 2018, the Fed, having left rates near zero for the better part of a decade, began to slowly increase interest rates. Equities responded very negatively to that. They were down about 13.5%. Bonds also produced a positive return of about 2.6% in that one quarter, very much helping buffer the volatility in that portfolio. During the 6-week period where COVID was introduced to all of us, the equity market was down about 23.3%, bonds also producing a positive return of about 2.9%. So this gives bonds a great ability to make a contribution in the portfolio in that they're attractive investments on their own merits. But in times of equity distress, bonds are that guiding hand that reach down, help stabilize the portfolio, buffer that volatility. And their superpowers, they then help you stick with your equity portfolio, your equity allocation, not panic and abandon your equities at potentially the worst time, that being the darkest part of a recession or a bear market, right? So bonds help at just the right time when you need the most help in your portfolio, and that makes them very unique amongst other asset classes, including real estate, gold, energy, etc. Now, that superpower is not always in existence, right? And so we all very vividly remember the Fed's interest rate increases in 2022 that took a big toll on both the stock market and the bond market. Stocks were down almost 24%. Bonds were still down 13%. That's a very unusual experience. In fact, many parts of the bond market, that was the worst return in the history of the U.S. bond market. And it has led to many calls for the death of the 60-40 portfolio. 60-40 meaning 60% invested in equities, 40% invested in bonds, has historically been a weighting that buffers equity portfolios enough in bear markets where you can generally stomach the volatility, right? So I don't think it's yet time to call for the death of the 60-40 portfolio, namely because of those unusual circumstances, right? We saw inflation go from 1% to 9.6%, and the Fed raised interest rates 525 basis points in a very compressed 16-month time period. That's more interest rate increases than we saw during the Great Financial Crisis, and those rate increases were spread out over 3 years versus 16 months. So bonds may not always be a hedge and help equities. It certainly has to be made in context, but in the majority of cases where there's equity distress, bonds are going to be a very nice buffer, provide positive returns, and again, have that superpower that helps you stick with your asset allocation and not abandon your financial plan and your asset allocation weights at exactly the wrong time. So what we've just been discussing are these defensive properties that bonds can play in a portfolio. That is that of hedging equities. It's a hedge unlike maybe put options where you have to pay premium to get protection. Bonds, you're earning a positive return while you are also receiving that protection. So this truly makes bonds unique in terms of their ability to work hand in hand with equities in a portfolio. However, bonds also play offense very well. So bonds move inversely with interest rates. When interest rates go down, bond prices go up. Why is that, right? You hear that expression a lot. Let's talk about why that is for just a second. Let's assume I bought a bond a year ago when the 10-year Treasury was at 5%. Today, it's at 3.75%. Well, what would somebody pay me today to receive my right to receive a 5% income stream versus their option to go to market and buy new bonds issuing 3.75% interest rates? Right? They would pay a premium. That premium is capital appreciation that I've earned on my bond in addition to that 5%. So that appreciation is the mechanism by which older bonds and newer bonds are adjusted in the marketplace to trade to reflect a common rate of risk around maturity dates and risk associated with the issuers. So if I want to think about having an interest rate view in my portfolio, if interest rates are expected to go down, let's say the Fed is going to cut interest rates, or if we just think inflation is going to moderate, right? Lower expected inflation should lead to lower interest rates. Both of those are scenarios where we could see bonds generate returns in addition to their coupons. So bonds very much play offense, much in the same way specific sectors in the equity market, energy, healthcare, technology. We might express those views about our optimism in the equity market through sectors. We can also express those kind of views through the bond market around moderating inflation or lower interest rates. So let me go back and backfill some of the risks specifically associated with investing in bonds. They generally fall into two categories. There's credit risk, or the risk that we do not receive repayment of principal or even any remaining interest rate payments that we are due from our borrower. And then there's interest rate risk, and that is how volatile is our bond going to move or change in response to changes in interest rates. Let's talk about credit risk first. So credit risk we can generally control by limiting our investments into very high quality issuers. So bond issuers are rated by a number of rating agencies. Standard & Poor's, Moody's, and Fitch rate most bonds, investment-grade bonds and non-investment-grade bonds issued by any party in this country. So those rating agencies start at AAA, go down to AA, single A, triple B, on down to C, which is sub-investment grade, and we would generally call those junk bonds or high-yield bonds. We're really interested in investing in the highest quality issuers in investment-grade bonds here. That would include treasuries, municipalities. Right? So municipal bonds, we typically think of being the tax-free version of treasuries, right? They're still issued by state and local authorities backed by tax authorities, so they can be very safe. And we can also look at high-quality investment-grade corporate bonds, a Microsoft, a Walmart, for example. So in the spectrum of municipal bonds, there are also bonds that are general obligations of a state or a county. There can be those that are backed by the revenue of specific projects. So a municipality might want to work with a real estate developer to develop or open up for development a section of land for, say, 300 or 400 new homes. They may issue bonds to put in water and sewer services to those homes, where those bonds, the repayment of those bonds is backed by fees that homeowners will pay for water and sewer services. If that revenue bond is now affected by just 400 or 500 homes, potentially fewer, versus a general obligation that's backed by an entire county or its taxing authority of an entire state. So generally, general obligation bonds are much safer than revenue bonds, although there are plenty of good quality revenue bonds. We primarily want to focus on general obligation bonds and stick in that highest quality of credit issuers. Many municipal bonds also will pay for an insurance policy to guarantee protection and repayment of principal and interest in the event the municipality runs into trouble. We like that. We prefer to invest in municipalities that are strong credits, standing on their own 2 feet, not relying on an insurance policy to provide them a higher credit rating. But all that information is available to investment managers as they select investments for investment portfolios. Lastly, the last form of risk here is interest rate risk, and this is how sensitive a bond is going to be to changes in interest rates. Again, I mentioned interest rates move inversely with changes, or bond prices move inversely with changes in interest rates. If interest rates go up, bond prices come down. Longer-term bonds will go down further than will shorter-term bonds. So bonds are not quite homogeneous as may be initially perceived. Bonds have to be managed. If we think rates are going down and bond prices are going up, we might want to own very long-term 10 or 15 or 20-year bonds. If we think the Fed's going to be raising interest rates, we might want to sell those bonds and buy much shorter duration bonds. So again, bonds, just like equities, need to be managed. Lastly, let me conclude with putting a frame of reference of where we are in the bond market today and maybe where the opportunity is. The bond market was really lost to us, I think, for the decade after the great financial crisis. The Fed moved interest rates to near zero and kept them there for the better part of almost 10 years. And when rates are zero, corporate bonds might be paying 2 or 3%. Treasury bonds, at one point, the 10-year Treasury traded below 1%. I'm not interested in buying a sub 1% yielding bond for 10 years, even if inflation is zero. So that really forced a lot of interest away from the bond market. But now, with the Fed having raised interest rates 525 basis points throughout 2022 and a portion of 2023, the bond market is now back. And we now have interest rates in the 4s and 5s that now give us that ability to earn attractive return on its own merits, and then potentially to be available there to provide that superpower benefit of hedging an equity portfolio, helping us stick with our asset allocation targets around equities and be able to stomach that particular volatility. Thank you again. My name is Neil Falkenberry. I'm a CFA, a Managing Director and Investment Advisor with Modern Wealth Management. Please let us know if we can help you with any conversations around investing in the fixed income market. If you like this video, please like, share, and subscribe.